Hi everyone, and thanks for joining us here today for our webinar on self-managed super funds. I see we've got a great mix of attendees, so I just want to sincerely thank you for investing your time with us. My name is Linda Parsons and I'm the Marketing Coordinator here at McMahon Osborne Group. We're looking at conducting these webinars events more regularly, given the changing nature of the world with various communication methods. So if there's a topic you'd like us to cover, please let me know and I'll see how I can best meet your needs. I've been with the firm now for a couple of years, and having come from a background in media marketing, I've really found the passion in this office for wealth creation and effective money management something that has really surprised me. I didn't realise just how much this company could care about creating financial success for their clients, and I had no idea just how many options there are out there to financially succeed. Today is one of these such options, as Tim McCarthy will take us through a discussion on self-managed superannuation funds. Many on the line will know Tim from all walks of life, but for those of you who don't, I just thought I'd give you a short background on Tim. Tim is one of the directors here at McMahon Osborne Group, having taken on that role since 2004 after beginning his accounting life in 1996. Over that time, Tim has worked with a wide range of clients, from very small mum and dad businesses and investors through to large private companies and a number of not-for-profit organisations. Tim is extremely well versed in all matters of finance, and one of the most notable points is that he is generally doing or has done whatever his clients ask of him, whether this be in business or finance in general. Born and bred and raised in the Lancefield and Romsey area, he is currently chairman of the two branches of Bendigo Community Bank at Lancefield and Romsey, and through that venture has been involved in the distribution of over $500,000 to the community, as well as now heading up a multi-million-dollar redevelopment of an old petrol station site to appropriate use for local business owners. So it's a bit of a rap sheet, but most importantly, he knows his stuff, which I'm sure you'll enjoy today. So I'll now hand over to Tim McCarthy for the rest of the session, and I hope you enjoy it.
There, Linda. Yes, thank you, Linda. Thanks for that. I guess it's quite a rap sheet. Probably handy that I actually gave it to her so she could read it off. So they'll be happy with myself. But thank you very much for the introduction, Linda. In particular, I probably want to thank everyone on the line today for joining us for this session on self-managed super funds. As Linda mentioned, there's a great mix of clients, non-clients, those with super, those without super funds. Oh, well, everyone's got super, but whether they've got self-managed funds or the like on the call today. And I really hope at the end of the time here together that we have the opportunity to at least impart some value for you investing your hour with us, really. And we do sincerely appreciate that investment. I just want to start off right at the start, something a little bit different to those who have been on webinars before. You may realise that at the right-hand side we have there's some polls that will come up during the session. There's also a chat, so you feel free to ask any questions anytime through it. The other one is, quite often in a webinar, I know I sit through probably one every month, two every 3 months sometimes, and perennially you sit on them and you assume, hang on, there's a sell coming at the end, and you don't quite concentrate. So I want to give you an assurance that at the end there's no hard sell in this session. It's about information, it's about education, and it's about development. And make no bones about it, we want to do business with our clients and non-clients, and we really are passionate about this area of our business, which is the area of self-managed super funds. But we want you to do it not because there's some great sales technique or some little trick of the trade, but like myself and the team here, that you're actually convinced that these topics are really, really relevant to yourself and will help you create a successful long-term financial future. Because ultimately, that's one of the key aims we have for ourselves and for our business, is that we want to create clients who have success, whether that be in their business or in their personal and investment wealth and in their lifestyle, which is just as important to us. Because we really are passionately in that belief that lifestyle is critically important to anyone who is our client. It's not just about money. If it's just about money, it's very easy. But it's about balance. That's what we're looking for. So at the end of the session, look, I love to do business with anyone who wants to do business in this area, and particularly some of you who are already doing some stuff with the self-managed super funds with our business. Love to investigate how we can make them work even harder for you. And frankly, you work hard, so why shouldn't your money work hard? Because at the end of the day, we're looking for your success, because your success does mean our success. So just wanted to have that comfort at the end. You won't all of a sudden get this, here's this whiz bang special offer, only valid for the next 23 hours and that sort of rubbish. That's not going to happen today. On the session here today, we've got a few different people from a few different walks of life, and breaking up effectively into the 4 quadrants that you'll see on the screen now. There's those who have self-managed super funds and those who don't, and there's baby boomers and there's Gen X. So baby boomer traditionally is those that are born, probably over 48 through till retirement age, and Gen X traditionally depends upon which book you read, but generally speaking around about 30, 31 through until about that 48, 49 area. And there's a great mix of people here. So what I want to make sure is that by the end of the session, each person can walk away and say, yeah, there's something that was relevant for me. There's something that I can grab hold of and apply that, and whether that be with us, with your own provider, obviously, I'd much prefer it be with us. At the end of the day, I want you to walk away with something you say, yeah, this is great value. This is something that I've wanted to do. So just to get that started off and to get us away, just want to run a quick poll of those of you out there. And just the poll is, which group do you fall under? Are you in which quadrant that we've got there? So you're seeing a screen at the moment. We've got a poll there. If you just click on whichever one you want to choose, which suits you, and we'll just get a voting in there. We've got most people have voted. That's very exciting. The response rate's excellent. And, okay, so we've just about got everyone voted, looking through there. Thanks very much for that, because what we can see now on this results here, I've got these results in front of me, 43% of you actually are in the no self-managed super fund Gen X, 29% each in the existing SMSF and baby boomer and Gen X. So no one's actually on the line who's a baby boomer without a self-managed super fund, which is really actually quite interesting. I actually didn't expect that result at all. It's very interesting because that indicates to me that those that have reached the stage of baby boomer are generally seeing the benefits that come with your structure and some of the areas you can grow from there. So thank you very much for that. I appreciate you providing that advice to us. For those who are in those stages of don't know what to do, don't know how to deal with their super funds, I wanted to start off by talking about long-term wealth creation and how we actually can do that. But before I actually get into that, I've just got to be really careful. I better actually pull up I better just close this poll and bring up our disclaimer. Look, you can enjoy yourself, knock yourself out reading that. Long story short, if you take the information on this webinar and apply it for yourself or with someone other provider, the extension of liability doesn't come to this session. Just go back to the start. It's a high-level discussion about self-managed super funds and what they can and can't do. So whilst you can go out and do, by all means, go for it. My strong suggestion is at least just get it checked off before you do anything. But moving through our session now, and we move into this quandary. What's it all about? What is superannuation? We talk to our clients and they say things like, I know I need to do something, but where do I start? Or how do I know if I'm on track financially? How do I compare to others in my age group? That's always something that I find interesting question. People are very, very concerned about how they compare to their supposed peers. Property or shares, or maybe other investments. Where should we go for? Do I do things inside and outside of super? And then, of course, the fundamental flaw that comes out all too often, which is it's just that bit too hard. It's a big effort. It's all a bit too hard, and we might just give it a miss. I really don't want that to be the outcome for any of our clients. I want to have a discussion now and be really clear about it, that there is no right and wrong answer. Now, the question of inside super or outside super, well, ultimately, we'll talk about this later, but a bit of both, and they both have very good reasons for that. Property or shares, again, different horses, different courses, and there's reasons why both have great value. So I wouldn't get too lost too on the comparison about how do I compare to people in my age group. It surprises me how often that question does come up. Just don't get yourself caught out with that one, because sometimes if you start thinking through that thought and thinking through that picture, I guess, then you start to limit your beliefs about what's possible and what's not possible. So let's not let that hang over our heads. The first thing I want to do today is give some terminology and change the way we talk about superannuation. For too long, we've discussed superannuation as an investment. Everyone says, oh, an investment, super's an investment. Please take that away from your vocabulary, and let's start with superannuation. Let's talk about the capital. Superannuation is our capital. It's not our investment. We can invest the capital, but the superannuation itself is capital. Because when we start to think of it as being capital, we start to change the way that we look at our superannuation. We start to change the way that we engage with this type of income, because we want to create something. I guess I find it always interesting that those who when we have control over something, we start to take a lot more interest in it. Whenever we control anything, whether that be financially or non-financially, we start to have some more interest in it, and we start to engage with it. And that's what I'm asking you to do with your superannuation. Start using the terminology capital rather than investment. Please do that, and start to engage with your superannuation. Because for long-term financial security, superannuation is clearly a great structure. There's a reason why so many people are moving this way. But we engage with our investments outside of super. We engage with investment properties. We engage with shares. Look, even the old insurance policies that some people have, we engage with those. We've got our home loan. We have cars, we have car loans. We care about them, and we have much more engagement with them than we do with our own superannuation, even though it's likely there'll be a core function of creating long-term financial security. So, and of course, what happens is, as night follows day, and this always happens, the older we get, the more interest we have in superannuation and our long-term financial wealth, which is really a shame, because the opportunity is there. So particularly now, I suppose, speaking to those in our Generation X, the opportunity is there to actually utilise your superannuation and your investment planning over the ultimate period of life when your capacity to earn is at its highest, to create a really, really sound, full life right through and even beyond your own life, which we'll talk about later on, but even beyond your own life, for the benefit of your family, children, and those who follow you. So if you're not already engaged with super, how do you engage with it? First of all, I'll make a suggestion that the fact that you're on this webinar means you've actually started to engage. So I appreciate that very much. But some of the other little things, know what your balance is in superannuation. If you've got multiple funds, have a look at them and see there may be a good reason to have multiple funds, but why do you have multiple funds? Know what the balances are. It's really interesting. A lot of people, when you ask them how much money do they have in superannuation, they go, oh, maybe 80, 100 grand-ish, perhaps, maybe, or it might. So that's the type of answer we get. Yeah, if I ask someone what's their car worth, they'll say, oh, probably about 15 grand. So why that? Why is there that apathy towards superannuation? A great way to engage with your super is to start to look at what the balances are and start to understand what the mix of investments is. Are you aggressive? Are you passive? Are you balanced? They're generally the three sort of levels. How are you engaging your superannuation? Because it varies for each person. Again, there is no right and wrong answer. But engaging with your superannuation and that capital that's there, I believe, is probably the first step to increasing the performance of the super fund. So another action from today, if you're not already engaged, get engaged with your superannuation. Start to consider how you would like your capital to be treated, because it's your money, it's your capital. We're going to fire off now into discussion around self-managed super funds specifically, but regardless of what you do, whether it's self-managed, industry fund, retail fund, managed fund, whichever type of thing you use, please, please, please engage with your superannuation. It may be a managed discretionary account. Understand and engage with it, because as soon as you start doing that, you start taking some interest. And the fact of the matter is, self-managed super funds are not for everyone and should never be considered to be for everyone, so please don't fall into that trap. But if you do go down that path, there's obviously a few fundamentals that come along there. And the first one is the sole purpose test. The sole purpose test applies to all superannuation, but it's particularly relevant to self-managed superannuation because, we'll talk about this in a sec, you are the trustee. Because never forget this, the sole purpose of superannuation is to provide for the retirement benefit of the members of the fund. So a couple of key elements there: sole purpose, not major purpose, not a preferred purpose, sole purpose. The retirement benefit, so it's not as you head towards retirement, it's for retirement benefit, and it's the members of the fund. So it's only worried about the members of the fund, not their sisters, their brothers, their business, or anything like that. It's for the members of the fund. That is a sole purpose test. 3 really critical elements to understand. With a self-managed super fund, they can have up to 4 members in the fund. And this is a really critical point. Traditionally, we've had mum and dad funds, I guess people have referred to them as, where mum and dad would be members of the fund, and as time passed on, their assets passed on, and they moved through the next stage of life, the fund would wind down, benefits are taken out, and it moves to the next generation. What we're now seeing a shift towards is a family super fund or a related party super fund, where there's a real movement towards creating a multi-generational wealth structure. The beauty of having 4 members in the fund is to understand this, is that you can only have 4 members, but they don't have to be the same 4 the whole time. You can have people come in and out of your super fund, and we're working through that with a couple of clients at the moment. Just be really, really careful here. If you've got 4 members of a fund, it's really important to take the members out of the fund before you introduce a new member. So if you've got 4 members in the fund and you're thinking about changing the mix, the member who you're looking to move out of the fund must go out and be paid out all their benefits prior to the new member coming in. That's just a really important step, or otherwise it's a significant breach. It could be all of a sudden, for a very short period of time, even if it's just one day, you have 5 members of the fund. So just be aware of that. That gives great flexibility and opportunity. Trusteeship's really important because this is where the control, the flexibility, we'll talk about this later on, really does kick in. All members of the fund are required to be trustees of the fund, and all trustees are members. So if the trustee of the fund is a company, and just while I mentioned that, if the trustee of the company is a company, personally here at McMahon Osborne, we're really believers in corporate trustees, particularly to be able to take advantage of a number of the benefits from a super fund in the way that you actually can stream money out of the super fund towards retirement. So if you've got an older fund, an older deed, and it may well be set up so that you're an individual trustee for whatever reason, which for all intents and purposes may have been the right decision at the time, no question about that. It's probably just worth a discussion to see whether or not you should be having a corporate trustee in that fund. Now, I know most of our clients, I would say the vast majority of our clients, have corporate trustees. One of the reasons occasionally clients will balk at the idea of a corporate trustee is the initial upfront cost. It's probably about $1,000 extra. It does add to the whole setup cost, somewhere in that sort of range. If you balk at that cost at the start, just be aware of what the potential costs are down the track, particularly when it comes to estate planning and management and control. So if you've got an individual trustee, please feel free to have a chat to us about what the benefits are of that and why you should have that, or perhaps why a corporate trustee would be more suited, especially if your fund's a little bit older. Because if your fund's a little bit older, there's been significant law changes over the last probably 7 years or so, which give a corporate trustee some benefits that individual trustees don't. And the other reason is, if you're thinking of actually setting up a fund as a family fund or using your existing fund as a family fund, then again the corporate trustee structure makes life a hell of a lot easier in the transition of assets, particularly with the way the ATO have applied some of the, I suppose, administration purposes recently, whereby all trustees are required to have their names on assets. If you've got trustees coming in and out, then you'll all of a sudden you'll have some issues around that, around management and mucking around. Whereas if the trustee is a corporate trustee and a director's change, well, there's no fundamental change to the trustee, no need to muck around with providers. Just something to think about if that's the way to go. And I guess this is probably the whole purpose of discussion today. There is no right and wrong answer when it comes to superannuation or self-managed funds, but there is information and there is being informed and making decisions around what suits you and your needs the best. The other thing to know about self-managed super funds and all super funds is taxation. So self-managed super funds have the same taxation benefits as super funds, as managed super funds do. What's interesting though is sometimes the way that they apply, so they still pay 15% tax on contributions, 10% tax on capital gains, which frankly is a fantastic rate to pay tax out on capital gains. So if you can make a significant amount of money and pay 10% gain, let alone if you have a property that's in your fund in pension mode, significant gain, that can be a share too. And if you're in pension mode in your fund, 0% tax, which is an absolute, great thing. You don't have to go to the Cayman Islands in Australia to have tax-free income. And there are a number of extremely well-structured people in Australia who are earning significant amounts of money or drawing significant amounts of money and not paying any tax because of the way they've set up and use their superannuation. The other thing to look at too with self-managed superannuation and taxation is when you actually pay your tax. So if you've got a retail fund or an industry fund, generally speaking, if you make a contribution, let's call it $10,000, 15% of that, so $1,500, is immediately set aside for taxation, and the remainder of $8,500 is invested appropriately, whether that be however that's invested into the market, according to the trustee that you're working under. For a self-managed super fund, of course, you're the trustee, so you can invest the full $10,000. Now, you may, down the track, you still have to pay the $1,500 in tax, depending upon franking credit policies and the way you're working that around. That's possible. But in the meantime, between the time you put the money in and the time the tax is due, which is often can be up to 18 months down the track, you actually can have that money invested. So we all know that compound interest is a wonderful thing. We have the money invested, the extra $1,500, an example, for 18 months generates this extra income. So that's one of the flexibility items the self-managed super funds have that's not available to industry and retail funds. So superannuation as a whole, I guess there's no secrets at all as to where it's going. It's going that way. Super is going that way, and the fastest growing area of superannuation, and one of the reasons to have this discussion today, is around self-managed superannuation funds. It's interesting to consider what's happening. In 2005, there was less than 290,000 self-managed super funds. Now there's over 500,000. I think it's the March quarter we hit the $500,000 mark in terms of self-managed funds. It doesn't necessarily mean a hell of a lot on the face value, but we consider that self-managed super funds, or superannuation guarantee, I guess, came in the early 90s. Self-managed superannuation and superannuation itself was around a long time before that. It really is a changing landscape to think this as takeoff has happened over the last, say, 7 years. Actually, it's interesting on that. Today, being September 26, 2013, 30 years today since Australia won the America's Cup, which is just quite a significant moment in Australia's history, of course, and we all remember Bob Hawke's big statements. But one of the things that's interesting about how the world's changed is that back in 1983, this terminology, capital gains tax, didn't even exist. We now live in an environment where capital gains tax is relevant for a lot of our assets, really our home, and being the home, I mean the house and 5 acres or 2 hectares around the house, and maybe a couple other small assets are excluded from this legislation, but most assets are subject to capital gains tax. And that's where superannuation can be, and self-managed super can be extremely relevant, because assets in this environment attract a far, far cheaper is probably not the right word, lesser capital gains tax rate than those outside of super. So it's something to be aware of. So what can the self-managed super funds do? They can use their existing capital to borrow money. You can't do that with retail funds or industry funds. You can have direct portfolio investments, which is often a really effective way to own shares, whether that be through a managed discretionary account or direct ownership. You can have a set of rules set up, and we'll talk about this later on, which give a very, very clear instruction left behind as to how your superannuation benefit is to be treated as you move towards retirement, but then also beyond retirement, beyond your death. And as we touched before, we can use this structure here to create multi-generational wealth structures so that our assets can be held in this entity and move from generation to generation in one of the most tax-effective manners. Because the reality is we're all going to be here one day, and not the bloke up there with the scarf with the sash on. We'll all be the bloke in the front of the room, or the lady at the front with the flowers on our head. And something we need to be aware of is this is going to happen, so how do we deal with it? How do we confront it? Something you may not be aware of is that superannuation benefit itself is not covered by your will. So regardless of whether it's an industry fund, a retail fund, a self-managed super fund, it doesn't matter what type of fund it is, superannuation sits outside of your will. So what that does, that means you have an opportunity to be able to think about how we want to use our superannuation potentially differently to the rest of our will. It also leaves a lot of discretion, because once you do pass away, the discretion, if any, goes to the trustee of the fund. And therefore, I will share an example that actually sort of explains this wholly. I have someone who I knew quite well, and he passed away in a road accident. And there was a payout from an industry fund, left behind a son, from a son who was probably he's about 4 now. And further to that, he was in a de facto relationship of sorts, in the sense that for part of the time he was living with someone who wasn't the child's mum, but part of the time he was. Anyway, long story short, the trustee of the super fund received a life insurance payout within the fund, and elected to distribute a vast majority of those, or not a vast majority, but a significant amount of those funds to the partial de facto rather than this fellow's son. So the son would have actually had the money set up for him. His father's passed away at a young age, and he's left this behind. That's the result of the trustee. The trustee makes that determination. In a self-managed superannuation fund, you actually can have that control. You can just direct on your passing exactly what is going to happen. And I just want to jump into another poll now, just quickly, which is around this area of estate planning and the like. And I'm just wondering where you're at with estate planning as they're listening to us. Is it all up to date and relevant and all sorted out, or perhaps you're in a situation where, I've got some documentation, but it needs updating. Maybe you're at the stage of, look, I've actually done nothing, but I will get onto it. I promise I'll get onto it. Some people go with, it's just all too hard. I'm not going to deal with it. Or the last one is, not my problem. Leave it behind for the others. They can all fight over it and bugger them. Leave it as it is. And just got some votes coming through here now. We're almost there with everyone. And what we can see, is that everyone fits into one of the first 3 categories, which is fantastic. I'm really happy to hear that, because it wouldn't have surprised me if we had some people on the line looking at the bottom 2. If you're in that category of, I have some documentation but it needs updating, which is 50% of the audience here today, or the other 25% of the audience has said they've done nothing but will address it immediately, please do that. Please take that as an action out today. Whether you want to do that, if you've got a solicitor who you've been talking to, if you want to have a look at your superannuation, if you want to just have a chat to anyone, but just do it, because really we've got to look at it and say, how does this happen? We need to take control of these situations. So thank you very much for those responses there. And I thought the best way to cover this was actually do a quick case study. I touched on the example of one of my friends before who had a pretty sad situation. This is a quick case study about how it all works and what's the determination that decides how our super is going to be sorted out upon our passing. There's basically three levels that we have to consider, and this in creating valid self-managed superfund rules. So specifically here, I'm not talking about wills and estates as a whole. I'm just talking about when you pass away, or in general, how superfunds work, self-managed superfunds, is there's 3 levels. So this is for any rules you want to apply within your self-managed superfund. And the first one is right at the start, legislation and law. We need to have legislation and law saying that whatever we want to do is permissible. A lot of people just want to go ahead and say, oh, well, I can do whatever I want to do. We can't, unfortunately. We'd all love to be in that world. But what we can do is we can find out what the law permits. So just as an example, if you have an account-based pension, which is as opposed to a transition to retirement pension, the law says that from that account-based pension, you can pay out an amount to the benefit of the member, and that amount has a minimum, but there's no maximum. So the minimum will depend upon your age, but there is this is not necessarily any upper limit or maximum payment that can be made. So that's what law permits. The second level then, if we keep going down, is the trust deed and the governing rules. So legislation and law say you can do it, but your superfund can only permit it if your trust deed itself says you can do it. So an example for older trustees, and if you do have a trust deed that's any more than, say, 3 years old, it's really, really important that you have it reviewed to make sure it can do things like allow you to pay reversionary pensions, allow you to borrow if that's what you're looking to do, allow you to create rules that will suit exactly what you want to happen with your super benefit. Really, really important that regularly, because legislation and law is changing. Consistently we've had changes in superannuation law, and we all worry about that. A lot of these changes are actually really, really good changes and give great opportunity to those with self-managed funds, but they only give opportunity where the trust deed and the governing rules allow it. The other thing your trust deed and governing rules can do is they can limit what's possible. So, for example, with an account-based pension, we said there before, the law says there is a minimum, but there is no maximum. Your trust deed, you could have it written into your trust deed that you want a maximum on an account-based pension, which may be an estate planning need or the like. So thinking through that thought, the trust deed and governing rules are really important, and the second level of actually creating valid rules. And of course the third level is actually doing the documentation and having it properly completed. So it's all well and good to say the law says it, and it's all well and good for the trustee to allow us to do something, but if we haven't put the paperwork in place, we've actually got an issue there. So I know at the moment we're working through with a few clients who the legislation and law allows something, trustee allows it, and just a matter of putting the paperwork in place to support exactly what they want to do with their fund, whether it be a pension, particularly reversionary pensions, whether it be through borrowing. We've all got to look at those areas and make sure 1, 2, 3 are in order, and when 1, 2, 3 are in order, away we go. So again, the account-based pension, the law says we have a minimum. Our trustee might say we have a maximum, but if we don't have any paperwork in place, we can't have anything. So it might seem a little bit technical, but hopefully that 3-step process can actually walk us through exactly what needs to be in place to make sure that our self-managed superfund rules are appropriate. I just wanted to talk through that through a case study about planning Luke's outcome. Now, I'll make it really clear at the start that Luke's outcome can be whatever Luke wants it to be. We're not telling Luke what he has to do. What's important here is the issues that surround Luke's benefit and Luke's future. So we'll just have the chart come up here where we've got Luke and Emma, who were married, and when they were married they had 2 children, Ben and Jess, and I'm reasonably proud of myself, for those who know about colours, that red and blue does make purple. So you'll see soon that blue and I think it's blue and yellow makes green. So Luke and Emma have the two children. They have Ben and they have Jess. But then they separate, Luke and Emma, and Luke remarries Rose, who has a daughter, Kate. And Rose also has a son, David, who's from a previous relationship. So we're not throwing anything that's amazing in the world. And simultaneous to that, Emma has a new boyfriend, Aaron. Now, Aaron's in black because he's the worry. Aaron came along after Luke and Emma had achieved financial settlement. Whether that was just good luck or good management, that's when he turned up. So Luke he's a little bit wary about Aaron as a whole. So Luke and Emma have had full financial settlement. Part of that settlement meant that Luke was left with $400,000 in his superannuation. And that's his major benefit, major asset outside of the house he and Rose own together. Now, what does Luke want to do? Well, he really wants to make sure that if anything does happen to him, that he's looked after Ben and Jess, which is really important to him. Also, Kate, equally important. David, probably slightly to a lesser extent because David's got his father who can support him to somewhat, and certainly Rose. They're the main people that Luke is in a position that he wants to make sure that if anything happens to him, those people will look after. So he's got a couple of issues. Now, if he had a super fund that was an industry fund or a retail fund, that would allow him to put together a binding death nomination. And that binding death nomination would say the amount of money or the percentage of his benefit that can go to each person, whether that be Ben, Jess, Kate, Rose, David, Emma, or Emma. He could have an amount go to them. Of course, he doesn't want anything to go to Emma, and wouldn't want, because they've already done their settlement, and he's quite keen to look after all those others. The problem becomes that's just a pure financial assessment of the money. So where the real concern comes for Luke is with Ben and Jess. And the concern for him is that, well, Rose is being relatively clear that she would prefer not to have the responsibility that goes with looking after the money for Ben and Jess, just not really going to be her go, and she'd prefer that not to be the case, not that she's got any problem with them, just a responsibility she really doesn't want to take on board. And previously to Aaron coming along, Luke was extremely comfortable with Emma looking after the money for the kids, very, very confident that everything would be okay. But now he's worried about Aaron, worried that, yeah, this Aaron, if he gets his hands on if anything happens to me and he gets his hands on the money that's to go to Ben and Jess, well, Ben and Jess might actually never see the money. So with an SMSF, what he can do is rather than just set up a simple, here's the amount of money that goes to each person, with the correct, so it goes through legislation and law, the governing rules and trust deed, and the proper documentation, he can provide a binding death nomination, but not more than just a binding death nomination, a set of instructions, a set of directions. There's the important thing. So his directions could be to the point of allowing for Ben and Jess for their money to be held in trust and managed by a nominated person up to the age of 25. But the funds can be used to disperse for, let's say it was for Emma. Emma's in control of the funds. She can use them to disperse solely for education costs, maybe the purchase of a first car up to a certain value, tertiary education, maybe accommodation costs up to a certain value. What can happen is that Luke can create a set of rules that actually means that for everything Aaron might prefer and might like to be able to do with the money, he actually can't get his hands on it other than to the extent Luke has permitted. So Luke can actually use that, I guess the SMSF will, for want of a better term, to create an environment where he leaves a lasting case behind. Because this is not something that's crazy and out there. It really is quite a simple arrangement where, unfortunately, Luke and Emma's marriage broke down and they've both moved on. That's very relevant in today's world. Now, that's relevant for a marriage breakdown. What about for if we think through older couples or older people who have a bit of money, and the way they want their benefits to be head down towards their children and grandchildren? See, with the way the world is now and divorce rates and the like, blended families are a reality. That's what we deal with. That's what we have to confront. So how can we, as best possible protect for the benefit of our children and grandchildren, if that's who we're looking to protect. I'll make the point again, there is no right and wrong answer here for Luke. Luke might well turn around and say, well, for whatever reason, Ben and Jess are going to, I don't want them to actually have some money because they're going to get the benefit of this, or I would rather than get more of the money or whatever. It's all okay. It's whatever suits Luke. But with a retail fund or an industry fund, he can only actually allocate an amount of money to them, whereas with a self-managed fund, he can provide a series of directions, a series of, I want this, then this, then this, then this, and this person to look after it. So really the question, going back to the estate planning side of things, is saying to ask yourself, if I died yesterday, what would have happened to my assets and wealth, including my superannuation capital? And if that's not according with your wishes, take action. Or if you need help, more than happy to help in that area. And for those of you who actually have a spouse, then extend that question to ask, what would happen if we both died yesterday? Because invariably the answer to that, in my own case, would be, okay, if I died yesterday, what would like to happen? I'd like all my money to go to Melissa because she'll look after it for the girls. But if we were both happen to have an incident, how would we want to deal with it? What would we want to happen? Who would we want to be charged with looking after our asset within our super fund? Because in our example recently, we've settled on a property just recently after something of an ordeal to get it to happen. And with that settlement of that property, there's a debt over that property. So our instructions are really quite clear as to if something was happening to both to us, what is to happen to both the super fund, the property, and the debt, and how it's to be dealt with. Because if you are in the case of debt within your super fund, it becomes really, or significant assets, it becomes important that they don't become a fire sale type of item. All I want to drive from this is to see how the flexibility of self-managed super funds, because the last thing we want to do is leave ourselves open or leave our family open to when we're most vulnerable. When we're most vulnerable, just after the passing, and next thing, well, and legal people, they do an excellent job, but sometimes we have vultures around who want to make their impressions, their rules, the way they think it should be. Let us take control while we're here. Let us take control of everything while we have control, rather than allowing others to tell our family what should or shouldn't have happened to our money. Because I guess what it takes to is, okay, where do we invest super funds? If we've got this money, where should we invest? And given the purpose of a super fund is for long-term financial security, the best investments are those that actually fit that profile. That's my view. So if you've got a super fund, why wouldn't you have, because it's for long-term financial security, why wouldn't you have assets you want to have for the longer term? Doesn't mean you shouldn't have assets that's more speculative or for the shorter term. So if you see a block of land and you think, gee, I wouldn't mind buying that and subdividing it and maybe picking up 4 or 5 blocks and put a house on one, and I might be able to do a joint venture with my brother-in-law who's a builder, great, go for it. So you should. But don't use the superannuation environment for that. Because the way I look at it is there's 4 pillars of financial success and balance for any person. And those 4 pillars really determine how we effectively invest and create our long-term and secure financial future, but with this balance. Because I said it right at the start, it's all well and good to have plenty of money, but if we don't have balance and lifestyle, what's the use of that? So the 4 pillars that this is really something I've come up with through discussions with clients over probably the last 15 years around what do people want? What do they want when it comes to financial success? How can we simply put it out to the world as to say, this is a really simple model. There's no rocket science here, but so most people say, yeah, that'll do me. So we want solid and reliable income streams. Now, whether that's from business or as an employee, is the choice of the individual. We do a lot of work with business owners, and consistently our messages are around cash flow and development of their business, because they want solid and reliable income streams. We run courses on cash flow and on business mastery. The reason why we run these courses is because we want to create solid and reliable and regular income streams. That's what we're looking for. Second one is a secure family home arrangement. Now, originally I actually had this down when I first started putting this together as being having your family home under control, whether that be owning it outright, having a mortgage that isn't inhibitive, or a mortgage that is under control. Then chatting to someone recently, he said, well, I actually don't. In our family situation, we don't look for that because we've got a long-term lease. We're very, very comfortable. So I've actually adjusted that to a secure family home arrangement, whatever that is. Secure, and by that I mean whether if you own your home, that you have your debt at an area that you feel, yep, okay, I can control this. Or if you have a lease, that you have a long-term tenancy, you have security, or whatever security is for you around owning and living in your family home. So they're two for a start. Then we go to the two wealth pillars, which is the wealth you can draw on now and the wealth created for post-working life. So if you have the example of the subdivision of the block, why wouldn't you have wealth you can draw on now? Everyone likes to have some money they can draw on now, whether that be for an extended break from work, some travel desires or needs, whether it's supporting education for your children, whether there's an unfortunate illness. And I was throwing this here. I sometimes hear people say, oh, well, if I had an illness, it's pretty easy solved. What I just do is I just claim on my insurance policy. But what about if the illness wasn't yours? What about if the illness was someone close to you? Therefore, your insurance wouldn't pay out because, of course, you're not ill. Having said that, I think life insurance and income protection insurance are two of the absolute fundamentals that anyone who has a family who has a family home security and income stream should be really, really, really reflecting on and investing in. But if it was someone else outside of you, where would you go? What would you do? How would you find the money? So you need to have some wealth you can draw on right now. That's what we all want to have. And we all want to now, because we're at our prime of earning money, we've got solid and reliable income streams, we want to create wealth for post-working life. So post-working life is through retirement, through aged care requirements, and even beyond that, through to our next generation. And I've just found when I'm discussing this concept with clients over this period, that we put those four pillars in place. They say, well, yeah, if I could do 4 ticks, I'd be pretty happy. What it also says to me is, I hear a lot of clients also mention to me, oh, when I pay my home loan off, we'll do this. When we have the home loan down to this level, we'll do this. I invariably sound to very, very low levels. We all know about synergy, and we all know that synergy creates bigger multiples for everyone. So please don't fall into that school that says, I have to pay my home loan off first before I can create any wealth I can draw on now or create any wealth for my post-working life. If you have them all running together and working together, you'll create an environment that really does secure your long-term financial wealth. Certainly something that Melissa and I have in our life, and something I would recommend to any client that they're thinking about, how can I deal with this? Work through the 4 pillars. What are the 4 pillars? What difference can they make to my life? So we go through all that, and we say the 4 pillars. We look at the 4th pillar, the wealth created for post-working life. That's what we're talking about more so today, but I just want to really address the fact that superannuation, I keep saying it, is not the be-all and end-all. Don't ever let someone tell you that is the be-all and end-all. Let someone tell you superannuation is an extremely effective way to create wealth for post-working life because, make no bones about it, it is the tax-free haven that we're looking for in retirement. So what we're looking for in retirement is tax-free environments. We're looking for the opportunities to really, really kick our super fund along. I just want to run through a case study about borrowing and what sort of difference it can make, because we talked earlier about our capital and investing our capital, using that model again of what can we do to make our capital work harder. And there is something of a pun there with the supercharge, so probably a pretty ordinary one, but there it is anyway. So Pete and Jen are a couple, and there we go, I've given you the first part of the section. They've actually got about $135,000 in super currently, and they're currently contributing about $150 a week, which includes the compulsory superannuation, of course, which is 9.25% now. So money tips into their super, and away it goes year on year. We look at, so they're in their mid-30s. In 25 years' time, if we allow for 7% growth annually on those investments that are in there, and we pay fees of, let's say, 0.5%. So in 25 years, they'll end up with $975,000 in their super fund. So, not too bad, nothing to be sneezed at, absolutely. But bear in mind, that's in 25 years. And think back to, as mentioned before, 30 years today to America's Cup. I actually heard John Bertrand yesterday saying that at that time they spent $1.5 million on the America's Cup investment. This year the investment for each team is $100 million. Now that's an extreme example, but the point is that money today will never be worth what it is in the future. So 975 is the number that would be there. That ticks along quite nicely. It's actually quite reasonable, but it's certainly nothing that's going to blow our mind or anything like that. That's just as steady as she goes. Let's just tick along. But what about if Pete and Jen, instead of doing that, take the $135,000 in capital and use that to invest in a property? And for the sake of the argument, let's say the property is worth $400,000. Let's say they get $380 a week in rent, so quite reasonable. I think that's a pretty reasonable sort of expectation. Let's allow for only 5% capital growth. So we had 7% on the first option. Let's scale that back to be a 5% capital growth annually. In 25 years' time, that same super fund, with that one adjustment using leverage, has $1.476 million in assets in the fund. Now, an absolute ironclad guarantee comes right now. There is no way that that will be the exact number. Not on your life. We all know that's the case. It's never the number. But the point is, the point there is, look at the difference. Look at one versus the other. Look at the fact that over that period of time, 25 years, an additional 500,000, an extra third in their super balance. Now, whether that, let's say it's not 5% capital growth. Let's say it's 4.5% or 4% capital growth. Instead of being 500,000, it's 300,000 or 380,000 or 420,000. In any case, you see the advantage of leverage. That applies inside and outside of super. The same principle. It's just now we're utilising that capital, because most of us can forget that that's actually capital that we have and we can use inside of super. So please have a look at that and think through it. How am I utilising my capital in my super for the remainder of my life, and certainly and beyond? The one, and let's give a word of warning here too, is this is, again, I've said it a couple of times, but borrowing superannuation is not the trick for everyone. We've actually got one horror story of a person whom we know who headed off to a pretty sharp property seminar and actually bought quite a reasonable property, not a bad property at all, and borrowed through their leverage through a super fund. Problem was they're in their mid to late 50s, and they're rolling the money over to the Self Managed Fund. They didn't seek, well, actually they did think that, they thought they got advice, and that was fair. They were actually probably taking advantage of a little bit, and they left behind their life insurance in their industry fund. One of them is a diabetic, and of course, life insurance companies weren't really that keen on 56-year-old diabetics. So what it means, I'm saying there, is just because it's great, don't think it's for everyone. Apply the principle to yourself and think, okay, is this something I would like to do? Is it a great way to use my capital? Yes, it is. But bear in mind, we talked about the fourth pillar. The fourth pillar is about the wealth for the longer term. Okay, so superannuation is a great environment. This specifically, I suppose, to anyone who's in that sort of Generation X area. If you're purchasing assets for longer term, but really, really strongly consider utilising a superannuation environment as the way to go. For those who are baby boomers, really consider that superannuation is the most effective tax vehicle for your retirement assets. So if you're heading towards retirement or you just started retirement, there's great opportunities there to assess your current asset base. Do you have assets outside of super? Should they be moved into super? What benefit would that provide? But just don't forget at all, and this is really, really important, that we talked about the three levels: legislation and law, the governing deed, the trust deed and the governing rules, and the properly prepared documentation. Make sure that those all permit and make it available before you actually go and make a decision, because what are we deciding about? What are we thinking about? We've seen a couple of case studies. We've seen a couple of examples that we're going through. We're talking about all this sort of stuff. For baby boomers, we're talking about tax, wealth, and estate planning. We're talking about transition to retirement, account-based pensions, recontribution strategies, anti-detriment reserves. We haven't even touched on a lot of this stuff, but this is all the stuff that's there with these types of models. Binding death nominations, direction statements, franking credit, tax efficiency. Then we go to the Generation X, thinking through gearing, leverage of capital, salary sacrifice planning, contribution reserves. Again, a really, really smart way to save tax. Binding death nominations and franking credit efficiency. They're all the things we're looking for in actually developing a superannuation future. Not just a one-off, not just a simple one strategy. Let's overlay multiple strategies and think, how can we get the best benefit for that? So I promise you at the start that wouldn't be a hard sell. So there you go. There's our details. You probably all know them anyway, but we'd love to have your details. Little plug for our app. Please get the app. We're pretty proud of the fact that we've actually an accounting firm who has an app. So you can enjoy it, enjoy that. But really just want to say thank you very much for your time today. I appreciate the fact you've invested your hour in us. We don't take that lightly, and we really, really hope that you've had an opportunity to take something out of that discussion. The reality is it's a high-level discussion where we don't get into the deep details of anything for any individual, but what we'd like to do is just create some interest so you can think, okay, what can work for me? What can I help with? We'd love to help with everyone. We look forward to that. So I just want to thank you very much for your time. Appreciate what you've done for us over the years as clients, to those who are clients, and we look forward to working with you all in the future. So thank you very much.